Hello, Business 630 Corporate Finance. This is Professor Hasse speaking to you live and in color from rainy Claremont, California, this Tuesday, November 8th, 2022, as we begin our third week of corporate finance. Our topic this week is concluding capital financing. We've talked about the time value of money. We've talked about financial statements. We've talked about bonds, and now we're talking about stocks. You are now this week doing your first case study. I'm going to talk a little bit about that in this video. The case study is a APA formatted paper on risk analysis of the company you selected in the first week. So that is your work for this week. It is due this coming Sunday, November 13th. If you do need extra time, that's not a problem. Just let me know. Extensions are available, but if you don't let me know, you're out of luck. So please, if you need extensions, let me know. Remember, we have our student hours on Thursday evenings from 6 to 8 p.m. If you would like to have questions, if you have questions about the work or anything like that, please feel free to contact me on Thursday night or via email or the discussion board at any time. Next week on Monday, I'll post case study number 2, which will be a capital budget analysis spreadsheet, a spreadsheet file to prepare a capital budget analysis of a company. You have 2 weeks to do that analysis, 2 weeks, and we'll talk about that at the end of this week. We're going to start talking about capital and capital budgeting, one of the key determinants of corporate finance. When is it viable or not viable in strategic planning to invest in assets? This all leads this week, and case study number 1 and study number 2 all lead to your course assessment case, which will be posted on Monday, November 21st, called the Electrics case study. This will be a combination of a risk analysis of a company, a strategic analysis of a company, and a capital budget analysis. You have 4 weeks to do that case. In addition, there'll be another case thrown in as well. So as we now begin our third week, the work begins, and now it's time to make sure you can manage this time, understand what we're trying to do, and I make myself available for any questions or concerns you may have. So let's take a look at, first of all, the work for case number 1. Case number 1 is the first of a series of case analysis. Now, why is it called a case? Why is that different from an examination? Why is it different from an assignment? Definitely different from a quiz, because this is graduate study. What is graduate study? Well, as many of you probably already know, graduate study is taking the disciplines and the models and the formulas and everything that you learned as an undergraduate student, either in business or whatever your undergraduate study was, and apply it to strategic and management critical thinking. And a case is an example of that. Assessing your ability to do research, to do strategic thinking, to do interpretation and calculations, and to do critical thinking of what the results tell you. And more importantly, probably than everything else, how you present the data. I know many of you work in companies, and I'm sure you've run into this a lot in your career, is when you have managers or supervisors of people who cannot communicate, who cannot explain what's going on, who cannot project a strategy, who have an inability of communicating with their employees. A common thread throughout the business world. Well, hopefully in the study of an MBA degree from the University of Laverne, you're not going to have those problems. You're going to learn how to write. You're going to learn how to do a spreadsheet. You're going to learn how to present some analysis and some research. We're doing all those things in this one class alone. So how you project and how you interpret and how you explain information is a key component of graduate work. So case study number 1, which is located in the case study file folder, let's click on that, is a case of a risk analysis and interpretation. In other words, you're going to be explaining to me a company's position in regards to risk. Are they a risky company? What's their credit rating? What's their cost of capital? Are they having any marketing? Are they having any environmental? Are they having any management risk? I'd like you to find that out and explain it to me. So there's 4 files given in this case study. 2 of them are exactly the same. Case study number 1, PDF and Word doc file folder. We'll go look at that in just a minute. That's the explanation of what you need to do. Then you have what is called a rubric. And I know many of you probably run into rubrics in the past. And a rubric explains how I will be grading and what I'm be looking for as a professor in your work. And then I have also given a sample case paper of what an APA formatted paper looks like and that I expect at the graduate level of this class. Now, this is a sample paper. It has nothing to do. Yes, the theme of it is very similar to this risk paper you're doing. But if you use this sample case paper and the data provided in it, you're going to be in big trouble. So again, it gives the reason for the sample of the case paper, and we'll show that to you in just a minute, is to make sure you understand what an APA format paper is and what I'm looking for in your interpretation of your research on this document. Okay, so these files are all the files that you need to be using in this work for this week. All right, let's take a look at the rubric first of all. So again, the rubric is a way of the professor telling you and explaining to you how he or she will be assessing your work of this specific case. And I break it down into 5 areas. I grade it either excellent, good, satisfactory, or unsatisfactory. I take a look at these 5 areas, and the percentages is 20%. 20% of the grade is on your paper focus, your organization, how you organize and explain the information I'm asking. Risk evaluation, risk analysis. Are you showing me the credit rating of the company? The credit rating being the Standard & Poor's credit rating, the credit rating being the Moody's credit rating, or the Fitch's. There's 3 companies that give credit ratings on organizations. I just want you to tell me one, and what does that mean? Now, this requires a little research. That's the subject of the main source of this paper, is your ability to find information. Then I want you to explain to me what the capital asset pricing model is and calculate the company's cost of equity. All right. Then I want you to tell me, what is the capital structure of the company currently? What is the mix of debt and equity on their balance sheet? What percent is debt? What percent is equity compared to assets of the balance sheet, their capital structure? Then I want you to give me a perspective of organizational and environmental risk. Has the company had a change in management or ownership recently? Are there factors in their market that are influencing this company? High competition, no competition. Is there a supply chain issue in this company's industry? What are the outside factors that the company really has not much control over that might influence the risk of this organization? Abstract support and elaboration. Remember, the first part of an APA format is the abstract. The abstract explains to me right up front what you are finding out in this document. What is the risk? Is it considered risky? Do you consider this company a risk or not a risk? And in the course of the paper, you're explaining that abstract conclusion to me. And then the overall presentation of the paper. A title page, an abstract page, your written work, resources, and the overall document, spelling, organization, grammar. My APA format required by me is a double-spaced document, double-spaced. So please, if you follow all those 5 areas, that's what I'll be doing and explaining and reviewing the grade. You'll get this document that you see in front of you on the screen back to you with your name on it and what percentages and what areas I graded in your work on this case analysis. You'll get a document, a spreadsheet analysis, but it'll be a PDF document of this format, which explains how I will grade your work once you submit it. That's the rubric. Here's the sample paper that I've given you. Now, this is just the reason for I'm giving you this sample is just so for many of you, maybe you haven't written an APA format or a graduate level paper recently. This will give you an idea of the format, not the type of writing you're doing, but the format of the document. APA format has a title page. It has an abstract page where you explain what you're trying to do in this document. Then it has the writing page. You're doing a risk evaluation here. You're doing an explanation of credit rating. In this document, they use the Standard & Poor's credit rating. You're taking a look at the beta of the company. That will determine your capital asset or your return on equity. What is the beta of this company? That will drive that answer. In some cases, the capital structure, you don't really have to show me their balance sheet, but I want a reference to where I can see that balance sheet in your document and what makes up the asset, the liabilities and equity position of your company. What percent of, in this company, in this case, Best Buy, what percent of Best Buy is debt? What percent of Best Buy is equity? The two combined should total 100%. Then a risk perspective area where you look at environmental, organizational risk. And there's the paper, okay? The last page will be your references. Where did you get the information? You do not have to use the textbook as a source, but everything else, wherever you get the information, you have to list it as a reference. If any of you get into study groups with fellow students in this class and talk about the problem and talk about the answers, you have to give me the participants of that study group that you used to work on this case, who you worked with to get information on this case. If you ask me about the case and specific issues, you do not have to reference that. So you do not have to reference the textbook or any questions you ask of me, but everything else where you get data, you have to reference and explain and show me like this, where you got your data. So as you can see, that's a fairly detailed, but also a very concise and organized document to explain the risk analysis and risk interpretation of the company you selected. That is the format for case number 1. Now here is case number 1. I posted it over the weekend. Most of you should have had a chance to look it over. I hope this video makes it a little bit clearer on what you need to do. But as I said earlier, you have selected a company in week number 1. That company will be your company that you're going to review in this case. You're going to do a risk evaluation, which is 35 points of the paper. Tell me the credit rating of this company. What is the beta value of this company? What is the required return on equity for this company? Use the capital asset pricing model. You'll have the beta. I give you the current risk-free rate. I give you the current market risk return. What is the required return on equity investment, knowing the beta, knowing the risk-free interest rate, knowing the market risk of return? What is the beta, or what is the required return on investment for your specific company? Then I want you to find for me that, as I've mentioned, the capital structure percentages. And then with those percentages, using the cost of debt as 8% and your company's corporate tax rate of 25%, calculate your firm's current weighted average cost of capital. You've already determined the cost of equity with the capital asset pricing model. Now, if I give you the cost of debt, I give you the corporate tax rate, what is this company's weighted average cost of capital? I'll explain that in a little bit in my lecture in a few minutes. Once you calculate, though, that's basically the calculation section, risk of evaluation of this work. Show me all those specifics. And then the majority of the paper is on your review of risk perspectives. What is the organizational health? What is it? How does that apply to the firm's viability and risk in the future? Is this company solid in their industry, in their market, or are they having trouble? Do they have weak management? Are they having investor revolts, shareholder revolts? Tell me something about the organizational health, and tell me about the environmental risk of this company. What is going on outside the organization that affects either the firm's success or its organizational status future? What are the political, social, economic, and other environments in which this company operates that could affect this? And then I go on to explain that a little bit more. APA format, double-spaced, Times New Roman font, 12-point font. I'm that specific on this. Sorry, but I'm being a geek. The length is a minimum of 5 pages. Now that minimum of 5 pages includes your title page, your abstract page, and your reference page. That's 3 pages. That leaves 2 pages of writing. The maximum length is like our sample paper. That is 9 pages in length. Your maximum length of this paper is 10 pages, no more. And if you need more details about APA format, you can click on this link and it'll give you additional details. But that sample paper should be sufficient. And knowing that double space Times New Roman 12-point plus the sample should give you a pretty good idea what I'm looking for. Welcome to graduate study. Interpretation, research, presentation, and above all else, thinking, explaining, organizing. That's what I'm looking for in this first case, due on Sunday, November 13th. Any questions, any review? If you want to talk to me about what direction you're going into, feel free to ask away. Okay, so that gets us going. Now the meat and potatoes of this week's topic. Okay, we're back to our Blackboard. And let's go over a couple of things, because by my viewing of some of your times you venture in and look at our Blackboard, which I can track, some of you are not spending much time in Blackboard, and hopefully you will going forward, because there's a lot of information and a lot of data there to help you. First of all, remember, these are our key dates coming up, and notice we have 3 case studies right in the next few weeks. One is due this Sunday. One, as I mentioned earlier, the spreadsheet format is due in 2 weeks, and then one on December 11th. Then you have the course assessment case paper, which will be given to you on November 21st, and that is due the last day of our class. So now we're getting into 4 case studies, 1, 2, and 3, and then the assessment case paper. So that's the core of our study in this corporate finance. You've selected your company. We go forward in analysis. Okay, So let's go to week number 3. That's this week. We conclude our capital fundraising analysis. We've talked about bonds. We've talked about time value of money. Now we're going to talk about stock. One of the key areas of financial capital, stock. Please, I'm going to refer to this lecture notes spreadsheet in my work and lecture today. That could be a nice template for you. Here's a nice section on what are the key indicators of a stock that you all should be aware of. There's this actual stock certificate of Tesla. A stock has a PE ratio, price earnings ratio, earnings per share, dividend targets. A stock is the equity position of a company. You are an owner if you own stock in a company. Here's our PowerPoint of Chapter 7 explaining stock. A key aspect of stock is the capital asset pricing model. Here is that determination here. It's the relationship of the cost of capital in the marketplace. Here's some explanations of what we mean by constant growth stock model, and we'll talk about that in our lecture in the spreadsheet. So there's some important data there to review and might help you in your background going forward as a risk analysis in case 1 and also especially in case number 2 in a couple of weeks. So let's take a look at that spreadsheet. So what have we studied these first 3 weeks of our class? First thing we studied is making sure we're familiar with, and that's what I'm talking about with you in our professor meetings. Are you comfortable with the course? Do you understand the Blackboard? Are you having any technology issues? So if you have not spoken to me yet, many of you are speaking to me this evening, Tuesday, November 8th. A couple of you have yet to sign on. If I do not hear from you today, Tuesday, November 8th, you will get a 0 for that work if you do not get in touch with me and set an appointment. So please do so. This is an important way of making sure that I know you are comfortable with our course and are able now to get in and do the work and the research of the 4 cases we have coming up. And also these first 3 weeks, we talked about the time value of money, of how we use money going forward into the future or in the present to determine its true value, how we use that as a gauge of investment performance, how we use that as a gauge of determining true or intrinsic value of an investment, the time value of money. We've talked about risk and return. What is the risk and return of a particular company? One indicator of risk and return is the capital asset pricing model, of which is part of your case number 1. How do you take a look at the risk in the market of the risk-free interest rate, how you take a look in the market of the stock market return rate, how you take a look in the market of your particular risk by the beta of your company. Put that all together, you determine the required rate of return on a stock, or what is also called the cost of equity. The capital asset pricing model is simply this. The risk-free interest rate plus what is called the market premium interest rate. And the market premium rate is the market return rate minus the risk-free rate. That's the market premium. So the market premium is added to the risk-free rate, but first you have to take that market premium rate and multiply it times the beta of the specific company. Whatever the beta is, or the risk. Remember, beta is a risk aversion or risk analysis of a company statistically, taking the last 4 or 5-year quarters and determining what the average return on investment was and comparing that to the overall market return on investment and how that deviates from the market. The risk-free interest rate has a beta of 0, no risk whatsoever. The market return rate has a beta of 1. That's average rate of return. The market return is basically the market return of the last quarter of the S&P Standard & Poor's 500. The risk-free interest rate of a beta of 0 is the current 10-year United States Treasury yield. The beta is the specific beta of the company. So in this example here, we have a risk-free rate of 3.371. We have a market premium of taking the risk, the market return rate of 10% minus 3.371. That's the market premium. And we multiply that market premium times the beta of this specific company, AA Corp, 0.8. Do the arithmetic. 3.371 plus 1 minus 3.371 times 0.8 equals 8.67%. That's the required rate of return of investors in the market at this particular point in time. In other words, if I want to buy stock in AA Corp with its risk and the current market risk of risk-free rate and stock market, equity markets, I would expect an 8.67% return. That's why I want to invest in this company. That will cover my risk and be competitive in the marketplace. That tells the company what they need to invest in assets to satisfy the needs of the stockholders, the equity holders. 8.67%. Whereas the risk of debt or the cost of debt is simply the interest rate on the debt position of the company times 1 minus the corporate tax rate. That's the risk of debt and the cost of risk of debt in the market. If I'm paying 6%, let's say I'm paying 6% on my debt. And my 6% of my debt, and my corporate tax rate is 30%. 1 minus 30%. Well, if I do the arithmetic, 6% times 70%, 1 minus 30, is 4.2%. That's my cost of debt. Taking into account the tax deduction I get for my interest rate, my true cost of debt is the cost of debt minus the deduction for tax, in this case 30%, 4.2%. So now I have my cost of debt. So I'm now in the particular example of this company, I have a cost of equity of 8.67%, and I have a cost of debt of 4.2%. What is my cost of capital? What is my WACC? What is my hurdle rate? What is my opportunity cost? Opportunity cost. And what is my discount rate? These are all the cost of capital. All these 5 different ways of saying it. Well, if I have a cost of debt of 4.2%, I have a cost of equity by capital asset pricing model of 8.67%. I take my capital structure. What percent of the company is in debt? What percent of the company is in equity? And now I weight those costs based on that. So if my debt position is 60%, thus my equity position must be 40%. It's got a total 100 on the balance sheet. Then my true weighted cost is 4.2% times 60%. Always go to 2 decimal places. 2.52% for debt. My true weighted cost of equity is 8.67% times 40%, the weight or the total of the capital structure for equity. And I get, again, round to 2 decimal points, 3.47%. So my total cost of capital is the combination of my weighted cost of debt and the weighted cost of equity, almost 6%. And that's the big kahuna. It's costing this company in their market equity, their current specific cost of debt, market cost after taxes, based on the weight of their capital structure, it's costing them 5.99%. That's a true measure of risk. The higher that cost, the riskier the company, the riskier the market. And today, on February 8th, 2022, those interest rates are going up. The risk-free interest rate today is a little bit over 4%. The return on market is dropping because of the risk in the market. Betas for companies are getting a little higher. The risk is going up, costs are going up. Inflation is causing this. So the cost of capital, the weighted average cost of capital, the hurdle rate of this company, the opportunity cost of this company, the discount rate of this company is almost 6%. How does that compare to prior years, prior quarters? This is where it is now, today. That gives you a pretty good estimate of the risk of a company. And that equates to going out in the bond market and borrowing money, and also in the stock market, the subject of Chapter 7. A couple ways of determining the return on equity. We just did it with the cost of equity, capital asset pricing model, taking market indicators. You can use this information also to determine the current value or intrinsic value of a company. Okay, let's use this example here. We just determined for the AA Corp that our cost of equity is 8.67%. Let's say this company plans in the next year, and every company has to announce publicly in investor reports and investor meetings that they're going to pay a $1.50 dividend. And they expect the company's growth rate to be 6% in the coming 12 months. And right now, based on market indicators, AA Corp is expected to return 8.67%. What is this company's true stock value? That's called the constant growth model. If I take $1.50 and divide it by the difference between 8.67%, let's put that in percentage, and the expected growth rate of the company, 6%, and divide that number into the dividend, I get $56.18. According to today, this company's stock should be trading at $56.18 in the market. That's its true value based on what they project to pay in dividends or equity return in the next year, what they expect to grow at in the next year, and what they expect to pay their investors in the next year. That combination whittles down into this constant growth stock valuation model of 56.18%. But let's say if I go to the market today and I look up AA Corp stock price as of today and find that it's $50 a share. I call my broker up, I go on Robinhood, I go to a variety of websites and see that AA is trading at $50 a share. The intrinsic value is $56.18. Should I buy this stock today? Should I purchase it today? Those who think we should buy it today, raise their hand. I do. Why? The stock is cheaper than its true value. I buy the stock today at $50. If everything goes right, it'll be up to 56.18 in the next year. I'm buying the stock cheap. This is why Warren Buffett's one of the richest men in the world. He looks for companies that are undervalued to their intrinsic value. He hires University of Laverne MBA students as employees, and their sole job is to track companies' true intrinsic value. And when he finds companies where their intrinsic value is much greater than their current stock price, he buys that stock and makes, hopefully, money if everybody's all correct. Vice versa, if the company stock is currently trading at $60 a share, would you buy that stock today? No, it's overvalued. Its true value is not 60 bucks. The market has it overvalued. Its true value is $56.18. So that's a key indicator of saying, well, if I buy this stock at 60, I might be losing money if everything goes the way it's projected into the next year. So I better stay away from it. It's overvalued. Tesla has been one of these stocks like this for many years, but it continues to find buyers. So here's how we equate capital valuation, the value of a stock, into what we expect it to make and its current rate of return into the next year. It's called the constant growth model. This model is huge in stock buying models and logarithms. What is its true intrinsic value compared to what its current market value is? And we just looked at an example here of that. And another great source of determining using the risk of the weighted average cost of capital. Remember, we just determined that the WACC of this company is 5.99%. We'll put that here. Let's say I know that this company is generating free cash flow of of $400,000 a year, that they're generating after tax, after operations, they're generating a free cash flow, extra cash available, $400,000 a year. Let's say their growth rate, okay, currently is 6% a year. Their cost of capital is 5.99% a year. And they're projecting $420,000 of free cash flow in the next year. What is this company's operation or value? If I take $420,000 and divide it by the difference between the growth rate and their cost of capital, which isn't much, I get that the company is currently valued at $4.2 billion. That's what their value should be, their value in the market. It's generating $420,000 a year of free cash flow with a growth rate of 6% and a cost of money of 5.99. That means they're generating, their value of their business should be around $4.2 billion. The higher, notice if I make the WACC 4%, look what happens to the value. If I make the WACC 4%, I lower it. Look at that. Oops, I did something wrong here. Oh, let's go back there. There we go. Okay, let's backtrack that again. I got a little bit, my computer froze up on me and all the calculations got a little raised. So let's go back through that exercise where we just did about value of operations. If I'm estimating a free cash flow of $420,000 per year in the year ahead, I have a cost of capital that we determined earlier in our problem as 5.99%. If I take that 420,000 and divide it by 5.99%, my cost of money, I get a value of operations of basically $7 million. In other words, that 400, it's taking $7 million of assets to create that growth rate of $420,000 in free cash flow at a cost of getting that cash flow of 5.99%. But if I lower my WACC, in other words, if I find a cheaper cost and I make my, let's say I say my WACC is not 5.99%, but 4%, notice the value of my company increases to $10.5 million. The point of this is the cheaper your money, the more value your assets are. And that's why companies strive to find better beta, better credit ratings, to make their risk in the market reduced and thus provide a greater return to their investors. A greater return to their investors will give them cheaper cost of capital and thus a greater value to the company. So that's how all this will play out, and we'll be talking a lot about this over the next few weeks. But the key part of chapter 7 is understanding what that risk in the market is, your required rate of return, and you can use that to determine the intrinsic value. Because what is a stock? A stock is ownership. It's nothing is guaranteed. The only way an investor gets money from a stock equity is two ways: dividend or stock growth. Either way, that gives return to the investor. If a company is not doing that, not providing enough return off their assets to pay a dividend or have the stock price go up in the market, investors will not be buying that stock and they'll be out of luck. So that's a key thing of understanding equity values, is understanding how that equity is determined and how that returns to the investor in the form of a rate of return. In this case, the capital asset pricing model, or also a dividend. So there we are for week number 3. You have a case of doing a risk analysis and interpretation in an APA format of the company you selected in week 1. We've walked through that of what I'm expecting. You have a rubric and a sample paper. And we've talked about and refreshing ourselves to the definition of stock and how that stock plays into what is called the weighted average cost of capital to determine the cost of capital or what it's costing the company to acquire debt, to acquire equity in relationship to providing a payment of debt to the investors back to pay off your debt, and also to give the expected return rate desired by the market of your stock. So a couple key terms: capital asset pricing model, weighted average cost of capital. You'll be looking at both these things in your calculation segment of your case number 1. All right, that's it for our week 1 introduction lecture. I'll be back again on Friday to talk a little bit more about these topics, and I'll be available throughout the week and especially Thursday evening for any questions you might have. So this is Rick Hasse signing off and wishing you a great week. Adios.